Welcome to the Good Food CFO podcast. I'm your host, Sarah Delavan. Today on the podcast, we're sharing my conversation with Melissa Facchina, who is the co-founder, co-CEO, and co-managing partner of Siddhi Capital. But first, I need to welcome our producer, Chelsea Steer.
Hey, Sarah. Yeah, I'm really excited for our listeners to hear this episode. I think it's kind of an unexpected take on, funding and yeah, I think it was a really great conversation. I'm excited for them to get to hear it.
Same.
So to kick things off today though, I think you know what time it is. I'd love to read a review for you from our Apple reviews.
I'd love that.
Okay. So this review comes from Phil Gorman of Cali Bagels, and he said, very helpful content. As a new CPG brand with no experience in food, Sarah's insights and tips are actionable and extremely valuable to me. Keep it up.
Oh, that's awesome. I love Cali Bagels, and they not too long ago launched into like bagel chips and have Old Bay
Oh,
seasoned bagel
yum.
chips. I have yet to eat them yet, but I mean, as an East Coast person originally from Pennsylvania, Old Bay is very near and dear to my heart. So thank you, Phil, for that amazing review. That's awesome. So, Chels, as we're recording this segment, Momofuku CPG has been in the news for, I think, about 2 weeks. We know, and some of our listeners may know from the articles that have been, around circulating regarding the situation, that Siddhi Capital is an investor in Momofuku CPG, and that in fact Melissa sits on the board of directors for the brand. So it feels like something that we need to say here on the podcast, and also to say, like, we're not really going to talk about that specific situation other than to say that I applaud the members of the AAPI community, the food founders who stood up for themselves, who created transparency around the cease and desist letters, and the fact that they were able to put a stop to whatever was, trying to be done in terms of trademarking the chili crunch term. I'm so like proud of them, and so, just like I said, applaud them, for what they did. I don't have anything to add to that conversation. I don't know much about trademark law. I don't want to give the founder and that company a lot of airtime here, but we needed to mention it, right? Because of the relationship with our guest in this episode. And I want to keep the focus here on my conversation with Melissa because it's a good one. As you mentioned, it's a refreshing take on venture capital. And I'm going to be really honest, when we have PR firms that reach out to us, and when Melissa's reached out to us, I thought to myself, a conversation with a venture fund co-founder. I wonder what she has to say. And I always say yes to conversations where I feel like I can learn something, and you can learn something, our community can learn something. So I was eager, to talk to Melissa, but I really didn't know where the conversation was going to go. And I remember getting done and just thinking, God, that was such a great conversation. I learned a lot. And I think one of the biggest takeaways that I'm really excited to share with our listeners is that venture funds are businesses.
Yeah.
And that at the end of the day, they too need to make money. And acknowledging that and really talking about that, like Melissa does in this episode, I think really frames the conversation, right? And sort of shifts the way that we can think about venture funding. I think the other really important thing that we talk about in the episode is, the fact that Melissa is not interested in working with or investing in brands that are going to sort of create financials and create growth plans that are, quote, what the investor wants to see. I've been strongly opposed to that in my work. When a founder comes to me and says, hey, can you create a financial projection? This is what the investors want to see. I say no. Like, I won't do that. I think it's unethical. I think it's leading a founder in the wrong direction. And so I really was happy to hear Melissa's take on that as well.
Yeah, and I think that the 2 points that you just made about the conversation really are centered in something that we talk about here all the time, right? Transparency.
Yeah.
And I think that's what made the conversation with Melissa so interesting and exciting and energized, was that here was somebody, right, who owns and founded and, you know, runs a venture capital fund company, being blatantly transparent.
Yeah. Yeah.
And I just thought, man, this is such good information.
Yeah. And there is so much packed into this episode. It's funny when we got when we got online together, Melissa had just finished. I can't remember how long of a run she had just done. I feel like it was very long. She had like the endorphins going. She was like full of energy. And we like just got right into the conversation, such that I don't think I like introduced her or asked her to introduce herself at all. So I want to be sure that I provide a little bit of a formal intro of who Melissa is and Siddhi Capital as well. And then we always like to note when our audio is maybe not the best. And so with Melissa's episode, we had just switched to a new podcasting, what would you call it? Like a
Platform.
format platform. Thank you.
Yeah.
And so we were working out the kinks, or should I say, I was working out the kinks. And so I think the sound is going to be a little bit different than what you're used to, but the conversation is a good one.
The sound is a little different, but it's not bad. I think it sounds just fine. Sarah, why don't you tell us a little bit about Melissa?
So as I mentioned earlier, Melissa is the co-CEO of Siddhi Capital, which is a venture capital fund she co-founded with Stephen Finn in 2020. They invest in the food and beverage industry. She has over 25 years of experience across the food and bev manufacturing and service industry. And prior to founding Siddhi Capital, she actually launched Siddhi Ops in 2016, which serves high growth and emerging food and beverage companies. And in the episode, you'll hear how those two companies actually work together and are very synchronized.
Yeah, I think it's something that really differentiates Siddhi Capital as
Yeah.
a fund.
Yeah. And their approach to really understanding a business
Mm-hmm.
that they're thinking about funding or who's interested in receiving funding from
Yeah.
Siddhi. Yeah. Currently, Melissa serves on the board of directors for Magic Spoon, Midday Squares, Momofuku CPG, as we mentioned, Aura Bora, and others. And I love this piece of Melissa's bio. In July of 2019, she co-founded and sits on the board of a nonprofit organization called the Women on Boards Project, which was formed to ensure that board seats in the CPG industry are filled by diverse women. Totally love that. And I also want to add that, you know, Melissa and I had such a great conversation and really enjoyed our time together. She so generously offered to come back to the podcast and answer questions from the audience. So as you're listening, if questions pop up, jot them down and then email us or, you know, submit them through the community if you are a member, if you're a Babo Yacht member, because we'd love to bring Melissa back to answer your questions.
Yeah, if you do want to email us any questions, you can always do that at hello@thegoodfoodcfo.com. All right, Sarah, without further ado, let's jump into it. As a good food founder, do you ever feel like your work is done in a silo? Is it difficult to feel confident in your business and financial decisions because you don't have a sounding board? Well, in our weekly CFO office hours, you'll not only get the chance to work shoulder to shoulder with the Good Food CFO herself, Sarah Delavan, but also with a small group of your peers. Together, you can support each other through the work of building a business on your own terms. May passes are available now on our website. Just visit thegoodfoodcfo.com and click on services. And now back to the show.
So you were saying that you grew up in food.
Yeah. I have I think a relatively unique background. My dad was a factory worker, ended up having a very strange opportunity to buy some bankrupt manufacturing businesses. And really that got me my first job on a factory floor at 11 years old.
Wow.
Slinging yogurt cups, cases, palletizing. That business, through great fortune, hard work, good luck, has grown into a massively successful co-manufacturing business that my father still owns privately and operates every day. I stayed in that business literally through high school and through college. obviously various jobs, mostly on the factory floor. Because, by the way, I have a younger brother by about 4 years, brilliant guy, finance driven. My dad is a pure blooded Italian who has zero, I feel like there's as I've grown up, I've realized there's two Italian men. There's the ones who dote over their daughters and are like, oh my God, I have to give my daughter everything. I have to protect them from the whole entire world. And then there's the other ones that are like, women belong in the kitchen, not in the boardroom. And very unapologetically, you should be cooking my meals, and the men have to go out and do the hard work, right? That was my dad. And so my brother got afforded all these amazing office jobs and corporate development and all this stuff that I was envious of.
Yeah.
And I was relegated to the labs and on the floor and all that stuff. I frequently joke that I was the one I probably not counted on. And now I'm hey, knock on the door. Hey man, what do you think now? What's up? And of course now he's so proud. Everything I did, this is exactly what my intention was. I'm yeah, dude. Sure.
Yeah.
But so I grew up 20 years in a beverage and dairy factory and fell in love with being an operator. Really watched the transition from true manual labor through semi-automatic to fully automatic to state-of-the-art infrastructure, from making branded products to private labeling and co-manufacturing some of the biggest brands that North America has seen.
Yeah.
And I fell in love with what being able to be an efficient operator afforded sales and marketing opportunities. So
I love that. I'm sort of pause. But can you say that again? You fell in love.
Yeah, efficient operations afforded sales and marketing opportunities. So many people think it's the other way around, that you must have consumer interest. You must have retail buyers. You must have people who are constantly promoting the product. And all of that is accurate, by the way. You have to have that.
Yeah.
But in all the best cases, even if you have that at the top-notch gold standard level, if you can't make the shit safely, cost effectively, efficiently, 100% of the time, it doesn't matter.
Yeah.
And so that's what really got ingrained in me. And I'm so grateful for that, because I had the opportunity then. I had another strange upbringing scenario where my dad was actually diagnosed with stage 4 cancer in his mid-30s and was given, I think, less than 3 months to live. I was 4 years old at the time.
Wow.
He ended up curing himself on diet, on vaccination, on all things that today Time Magazine writes about in immunotherapy. But in the 1980s, it was quack medicine.
Yeah.
And so despite living in a family that was producing mass market quality product, I was growing up in a household that was teaching you about macronutrient density, about whole foods, about making sure that food was medicine, many, many, many years before any of this stuff was talked about.
Yeah.
And so I had this really beautiful blend of knowing that the food system was about to have a need for change, having that passion built into my core, and then realizing that all those amazing entrepreneurs who wanted to change the industry lacked the education on operating. So I left our family business 11 or 12 years ago. And by the way, I say our family business. I was once defined it as a family business. And my dad was like, this is not a family business. And I'm like, all right, it's time for me to go. So that's pretty much what led me out the door. And really, I'm grateful that I left. But that's what made me start my first firm, which was Siddhi Ops, a full execution operating firm. What does that mean? 15 operators, not who give advice, not who are consultants, not who look at your business from 30,000 feet and say, we should do A, B, and C. People who literally take over the jobs of everything south of sales and marketing, who go in and entirely edit your manufacturing, who go and procure the right equipment, get you set up with the right co-manufacturers, secure your IP on the floor, totally rip apart your warehousing structure, where geographically you're set up, what you're paying per pallet, redo your palletizing, your, packaging configurations, literally everything that drives an efficient dollar, and own the entire process of procuring all the way through delivering.
Yeah.
And so we've built over 425 food and beverage companies. We've had the privilege of being part of 93 exits. That team launches still today 220 to 250 new items every year across every product category. We've negotiated 2,000 or more commercial agreements around the world for co-men, for suppliers, JVs, et cetera. We've built 6 facilities that total $250 million in asset value. So we were the operators that people came to launch, to scale, to de-risk, to untangle, to fix.
Yeah.
And then that got us a lot of notoriety in the investor community. And so by 2019, our firm was the hired diligence partner to 44 different VCs, PEs, family offices, and sovereign wealth funds. So if people were writing checks in the space, a lot of them were using us behind the scenes to really evaluate these businesses. It was that sliver right there that gave me the window into what I'm now passionate about and why I started Siddhi Capital, which was we had a lot of money pouring in the space and a lot of people who may have been good intention for why they wanted certain products to move forward, but didn't understand what it meant to build a CPG business and put parameters, asks, requirements on these companies that were impractical. And then they would turn around and fault the business for not being able to hit impractical objectives.
Yeah.
And I was getting sick of being the service partner at the table, fighting this dynamic, sometimes with the investors, by the way, who brought us into the mix.
Right.
So I realized that the only way to turn that conversation was to be the one who was writing the check.
It's fascinating. One of the things we talk about on the podcast all of the time is finding the right partners for investment if that's something that you are looking for. And the number of people who come to me and say, hey, Sarah, can you make a financial forecast for me? The investor is looking for this rate of return over the next 2 years. And it's like, I don't play that game. If I'm building out a financial forecast, I'm working with you, the founder, to figure out what is realistic and what can be done and what the return will actually look like in 2 years, right? I'm not and refuse to create a financial forecast that we're going to give to anybody that is just based on what someone is looking for. That's not going to serve anybody, right? That's why you hear, in my opinion, and I would think you would agree here, that's why you read news stories about, well, funding got pulled from this company, funding got pulled from this one because we weren't seeing the returns that we expected. Well, your expectations were out of line.
That's 100% right. And kudos to you really for having that line. That's the type of conversation we have with our founders and management teams now is very simple. We're going to go in and diligence the shit out of your business. You're going to experience a level of diligence that you've never experienced before. And by the way, just to clarify, when I launched Siddhi Capital, I decided to merge the companies together.
Right.
So the entire ops infrastructure came in-house. We are a weird makeup where we're 1/3 investors and 2/3 operators. That gives us the ability to leverage all the same infrastructure we had before. And so we know everything about your company. When we get through, we literally hand a founder a 40 to 80 page diligence report that tells them everything about their business. 99% of the time they say to me, oh my God, you know my business better than I do. And so we start by saying, don't lie. Don't pretend like stuff doesn't exist because we're going to find it. And so here's what I want you to know. I want to change the fear that has been created around the investor-investee relationship. I'm not here to punish you for past mistakes. I'm not here to hold over your head stuff that you aren't maybe proud of that you did by changing numbers or sliding product through that didn't really match nutrition standards, but you put it through anyway and sold it through the system. I'm not here to do any of that. And by the way, I'm also not here to collect all the stuff you did and then hit you over the head on a valuation change. We may tell you that the valuation change needs to occur because the market has changed dramatically and it's not really going to help you to continue chasing these things that you're never going to hit, but there's going to be a reason for it. It's not about the makeup of your business. Where I get with that is when I see anytime someone sends me, here are my projections for the next 5 years. And I see, I don't know what direction I'm facing, but whatever it is, up and to the right, My first instinct is every time I send a note back that says, thanks, no thanks, try again. What are your numbers really going to look like? Because what you just sent me is completely fabricated.
Yeah.
And we're the firm as operators who understand, like, there are ebbs and flows.
Yeah.
I actually don't care as an investor if you miss your quarterly forecast. I don't give a shit. I care that you know why you missed your quarterly forecast.
Yeah.
And the likelihood of why you missed it is because it was wrong to begin with. You didn't count on all the other extenuating circumstances, the environment, how people put you on shelf. Things are always more delayed than they expect to be, right? Or you over-engineered top-line growth. I don't care what it is. It was likely the wrong number. So now let's reset that number.
Yeah. And okay, I'm pausing again. I want to dig into this a little bit. Something else we talk about here all of the time is forecasting and the need for a projection so that you have something to measure your outcomes against. I think that that's critical, right? It's needed if you're looking for investment. And what I think I hear you saying is like, a lot of people are going to get it wrong because there's so much that you don't know. And there's so much fear. I think there's so much fear around forecasting and the fear of getting it wrong that people either don't do it or they go into it with like, well, I'll project, 10% growth this year. And,
that's all right. And look, that you're correct that you need to have something to measure against, but the problem is much broader than that, actually.
Okay.
One, your cash flow is dependent on it.
Oh, yeah.
And when you look at cash flow, what amount of money you need to raise and by when is dependent on it. How much cash you have available to put toward marketing and trade spend is fully dependent on it. How much inventory you can hold is fully dependent on it. When you can hire these senior level hires who you have built in your plan who can take you from here to here is fully dependent on it. And there are times, by the way, where we have founders who will probably do the financial forecasting correctly. And I'm talking about businesses, by the way, who might have made it to 10, 15, 20 million. So they're able to bring folks in who have some acumen. And they look at it to themselves and say, shoot, one, I'm not going to get the kind of growth that I think I need to attract investors with these numbers. Two, oh my gosh, I need a lot more capital than I thought I did to do this. And my dilution is going to be huge. So what they do instead is they say, we're going to edit this. We're going to change the numbers to make the top line numbers look bigger and make the cash need look smaller.
Yeah. So
that I can bring in less cash and I can make more investors interested in looking at me. All great if you can close around until 6 months later when it all blows up on you.
Yeah.
And that's what they don't appreciate. And so that's the kind of thing that we stop in the tracks and say, we actually will not write you a check until we tell you how much cash you actually need.
Right.
To get to a certain point. We are all willing to talk about having the company properly capitalized for 2+ years, at least in this macroeconomic climate. Your dilution might be what it is. Don't give a shit about it. Why? Because if you're doing your job as a management team, we will incentivize you by doing a build back plan. Even in writing as an investor, we will set up a plan for you to earn back equity. But we have to get the ship righted with the right amount of capital to get to the growth rate. And by the way, if your growth is only 20, 30, 40% year over year, which by the way is still a lot in some circumstances, I care more that your bottom line is expanding.
Yes.
It's a business, not a nonprofit. Too many people have been running nonprofits in this industry.
Totally.
And then they wonder why investors are displeased. And it's because you can't sell a cash siphoning business to anyone.
Yeah. And no one will fund it in any form, really. Maybe someone in your family, who will give you funds because they believe in you, you know what I mean? But like beyond that, if you need to deliver financials to someone for them to give you money, it's not going to happen.
Listen, this is a little bit of an egregious statement, and I don't mean it as absolute as it sounds, but this is mainly an investor created problem.
I believe that.
Investors want to see a certain level of growth in their businesses. What a lot of people forget is that investors have investors.
Yeah.
And so we've all told people what we expect our funds to return. And so that means that each underlying company, not everyone's going to make it. So you got to throw out the dogs, right? And the few that do make it have to perform better than what the multiple was you thought that, the average was going to perform.
Yeah.
And so the result of that is when you have to report out to your investors how they're going to make their money back, you start pushing these companies into unrealistic objectives.
Yeah.
And it's all on paper. And it's all bullshit because at the end of the day, someone actually has to buy the thing to make it worth something. No one's making any money until someone actually buys it. And so this is, you can clearly tell I'm getting loud and my hands are full, but I'm very passionate about resetting the practicality because food is an emotional business. Food is not going anywhere.
Yeah.
We all eat the same amount every day as we did the day before. The only thing that's happening in food is it is growing because the population is growing. But if we can't reset what it means to have business fundamentals in creating better quality food, big food will win 100% of the time because the risk is not there.
Agreed. Yeah. So getting back to the story of Siddhi Capital, you've merged the two businesses together. You're vetting, I wouldn't say vetting businesses, but you're really digging and examining and understanding what is going on.
Kind of two things that are at the crux of today's time,
Okay.
which is there's not a lot of capital to be had.
Yeah.
And so how do you pick the right investor in that circumstance?
Mm-hmm.
And then two, how do you shift your business model so dramatically to fit today's standards? So I have a lot of empathy, by the way, for entrepreneurs who started their businesses in 2016, 2017, 2018, 2019. They started it under a totally different premise. And most of those founders, right? We all start, if you're an entrepreneur, you start something because you think the time is right. You think you're right. You think there's an opportunity. Generally, most of us don't look at a circumstance and say, oh my God, I would be terrible managing something in this time. So I'm going to start it anyway.
Yeah.
We actually start it thinking you'd be really good at it, right? So most of these people were growth-oriented folks, passion-driven brand folks who basically got told money is easy. Tons of money is flowing in the space. As long as your business is moving top line, no one gives a shit what you're spending and how you're getting there, right? Margin, who cares? It'll come with volume. Don't worry about what margin is, right? These are the things that these entrepreneurs started in. And so now we're saying, now the definition of now is in the last 18 months, we're saying, oh, just kidding. All that's fake. We now don't want you to grow quite as quickly. Or if you are growing as quickly, all the other fundamentals have to be accurate also.
Yep.
You have to be efficient with every dollar you spend. Margin, and contribution margin at that. When are you going to be cash flow positive? We're now looking at evaluating your business potentially on a multiple of EBITDA and not on forward, 12-month projections on, a multiple of revenue. And by the way, you can't just spend in order to get growth. You have to find a different way to get there.
Yep.
And these entrepreneurs are going, huh? And then, by the way, on top of that, we're saying, oh yeah, those valuations we gave you before, they're too high. So we told you were worth $50 million. That's not true. You're now worth $30 million. And so the next round that you have to raise is going to be a down round just because the economy is sending in that direction. And the amount of money that you thought you needed is not available. So how are you going to manage growing your business with less capital? Like it's a shitstorm. And that's unfair. And so, what we've been doing and trying to do is say, not everything is bad in that equation. And so the first thing is everyone has to understand, by the way, who is looking to raise capital. There are a couple different batches of investors out there by knowledge. You should know what type of knowledge you would like to have as an investor. But more importantly, there are investors who have capital and there are investors who do not currently have capital.
Okay.
And what I mean by that is they might have depleted their last fund, have to go out and raise another fund. And we all have to raise money, but it's taking longer. It's harder. less money's coming into the space for us. And most of my fellow investors I have found are not being honest about that. And so they're going lengths with these businesses and not saying, but I have to go raise it. Or I don't have all my fundraise yet, so I can't start investing, or whatever the answer is. So the first thing is ask the investing partner that you're talking to, do you have capital to deploy? And what is the timeline you can deploy it on? The next thing is the investors who do have capital, and Siddhi does have capital, is we have to look at our portfolio and say, where should we be holding capital back to play defense for the companies we already have in-house that we know are going to need more cash, versus go and deploy it in a brand new business that we become a new investor in. And so it's this dance every day.
Yeah.
And so that's the first thing everyone should know about investors when you're approaching them, is find out if they really have capital and find out if they really want to invest in new businesses. Because if the answer is no, and they are out there getting data from you and just trying to date you for the future, it's great. Date anyone you want. Don't go dump your whole business and data with them, please, because they're talking to everyone. And so do not give away everything about your company if someone's not serious.
I think that's great advice about the data dumping, right? And the questions to ask up front. I think that there's, for a large part of the industry, a lack of transparency about how investing works. I mean, just what you shared a moment ago about the fact that as investors, you need investment, right? Like you're getting funding that then you manage and invest in additional, right, into the businesses. And I think a lot of people don't realize that. I think they think, well, there's money here and it's just here and we,
So let's take a step back.
Yeah.
Let's educate on that for a minute.
Yeah, I would, please.
And let's educate it in the context of today's market, because it's really important to understand. So there's many types of investors. And I'm not talking about VCs or PE funds that you go to. I'm talking about people who invest in VC and PE funds.
Okay.
So you have angel investors. They tend to write small checks. They tend to write them direct to companies, and they tend to write them in startups. Every now and then you might have an angel investor that invests in a fund, but most funds of size in the several $100 million range, they have requirements for the size of investor and how much personal capital they have to invest that they're allowed to take in. So someone may need to have a $1 million net worth or a $5 million net worth in order to be able to invest in your fund. So you're moving out of the angel investor category. So there's high net worth individuals and ultra high net worth individuals, people who have their own personal capital. They've built businesses, they have inheritances, they have been great investors, whatever it is, they have a huge amount of cash internally that they'd like to deploy. Sometimes it might be direct into companies and sometimes it might be into funds for other people to manage. The step above that is like in what we would define loosely as institutions. That might be universities. It might be pension funds. It might be government programs. It might be large businesses and conglomerates that would like to invest in a fund. And they all have their own criteria, what they need to see as performance metrics. And so what happened in this economic boom over the last decade plus is that people got flush with cash. And then COVID happened, and ironically, people got even more flush with cash. And so they're investing it in all these places, right? So high net worth individuals and institutions have dumped a shit ton of money into the market. I'm talking about every market, not just food.
Right.
What ended up transpiring is now we're dealing with inflation. We're dealing with massive supply chain issues still from COVID. We had a terrible disease, right, that shut the whole world down. All of that has domino effects. So the money that these folks invested that they thought was going to come back to them in 5 years' time, 7 years' time, 10 years' time, that's usually the horizons of funds, okay, hasn't come back yet. So they don't have the liquidity to go and give again to another fund. They haven't received the money back. Second, to make it even more complicated, we have two other things. We have the stock market that's still booming, right? So people can put their money in the stock market relatively risk-free right now and get a nice return. I think last year's return was like 18.5 or 20%, something ridiculous. And we have 5 to 5.5% tickets in just high yield savings accounts.
Right.
So there's no risk at all that you can just put your cash in. Okay. So there's no incentive to go and take a risk to get a 2X, a 3X, whatever it is.
Yeah.
So that's where the liquidity constraints have come from. People are either holding back their cash and holding it in a less risky endeavor so that they can deploy it. Because, by the way, all professional investors, people who invest for a living in any vehicle, know that some of the best vintages occur when the market collapses.
Yeah.
So people are waiting for those opportunities at this stage. So one, everyone's waiting for money to come back in, and businesses aren't really selling right now because the M&A market is terrible.
Right.
And then two, the cash that they've made since then is just waiting to take advantage of being able to dump it into a great time.
Right.
So that means people like me who go out there and raise money for a living. And by the way, the other misconception on investors is, at least for someone who has built an investment firm, I'm also an entrepreneur. I also have to run a business every day.
Right.
I also have a budget I have to abide by, and forecasts I have to hit, and people I have to lead. All the same freaking problems that these CPG founders deal with, so do I. I'm just not dealing with them in perishability.
Right.
I have to go convince people that I'm the best place for them to put their money that they have right now. And I will tell you, luck has been very kind to us because the operating model resonates with these people. And they look at it as a de-risking measure. And we have raised capital far easier than most of the other firms out there. And we are grateful for that. We still struggle. It is still a fight. I still claw to get dollars in the door, but I think we've had a slightly easier time. That's what you're dealing with is these firms who need to go get cash.
Yeah.
And really, they're investing the cash they had over a 2 to 5 year time period. So if they announced that they raised a fund 3 years ago, you can better believe most of that fund's already depleted.
Yeah. This is so interesting. I don't know a lot about the world of funds and how the background works. I think you learn about this one and that one, you make some assumptions. If you're not really in it, you know what I mean? And it's really valuable information because I think, transparency, I think, is so valuable and so helpful and important. And we talk about transparency of product. We talk about transparency, like financially, transparency during negotiations, I think is really valuable in sort of changing how negotiations go down. And I think transparency about where money comes from and how money becomes available to go into investment. Listen, investors have been getting a really bad rap.
Yep.
Lately, right? Like we just gave them a bad rap a couple of minutes ago.
I'm giving my own fellow investors a bad rap sometimes. And I own that. I own it though, because I want to help change the narrative.
Yeah.
I own it because I don't believe that all the people who co-invest alongside of us are doing it with bad intentions. I don't think that that's accurate. What I think is that they're also stuck in a position. I don't exactly know how to articulate it. And your point on transparency and negotiation, I'm the biggest, I've negotiated more co-manufacturing agreements than probably anyone you'll ever come across. My MO is 100% the same. I'm not giving you something that's over here that's brand friendly. Do not give me something over here that's company friendly. I'm giving you right down the middle 100% of the time because I got to be happy with you and you got to be happy with me. And if you're not making money, neither am I. So let's just cut the bullshit and start in the middle.
Yeah.
And figure it out. Right.
Yeah.
And it works every single time.
Yeah. Yeah.
And so it's the same thing on the investor front, which is you have to ask your investor, what are you looking to achieve?
Yeah.
By putting your capital here. And we should be able to tell you, listen, for us to deploy brand new capital, this is true from Siddhi's mouth, we expect a 3x net return on that capital. If we're looking at deploying capital in a business we already have, we're not looking at dollars again necessarily as having to return 3x. We might look at it as defensive in protecting the dollars we already have. We might look at it as our original dollars are tracking at a 3 or a 4 or a 5x. We'd like this one to track at a 2x because we know the company needs to grow from here, right? Like, and we will tell our companies that there are times where we will sit down as lead investor. And I've had some of my portfolio company founders come back to me after and say, we have never experienced such a thing. We have sat down with them and shown them our full investment returns for their company. And said, here's every scenario that we can map out and exactly what we would get in each of these scenarios. Now, when we price your next round at this, or this is what happens. This is why this is our sweet spot. By the way, I don't give a shit if you pick option A, option B, or option C. You can pick how you want it done, but I need to hit this area right here. So just understand that. And they're like blown away.
And is that where, so I want to dig into this a little bit. You're saying this is what we need from you, right? And earlier we talked about how when you're working with an investor as a CPG founder, let's say, you need to be honest about what's realistic for your company to do and how it can perform. So connect those two dots for us.
Sure. Let's actually disconnect them first.
Okay.
Which is what happens most of the time. Everything looks great and rosy on paper at first. But as you get farther and farther apart from each other, that's when the misalignment between the founders and the board, which is usually made up of investors at a certain stage, happens. And once you have misalignment of where you're going, it's really hard to get anything done in a business, and it's really hard to figure out the path forward. And someone might say, but Melissa, if I'm honest about where I'm going and you're honest about where you need to go, we might not overlap. And my response to that is, you're damn right we might not overlap, and you should thank your lucky stars you know that now. Because what makes a good investor for your business is someone who wants the same outcome as you, expects the same outcome that is practical as you, and who can support you in getting you there. Far too often, the investor has expectations, and that's partly the brand's fault because the brand has put out the wrong expectations for these investors. Granted, I agree that investors push a lot of pressure about those, but like, someone's got to be honest first, okay? And so if it's not the investor, the brand has to be.
Yeah, I want to interrupt and just say, like, I just had like a strange aha moment. It was like, how did I not realize this first? It's like, because you're like, someone has to be honest first. It's quite possible that the investors are being honest in the return that they want, right? And then it's eagerness on the part of the brand founder. They're like, well, I want to show them the return that they want.
There's a few things that happen here. One is desperation for capital.
Yeah.
One is desperation for a specific investor. And by the way, I can't talk for any other firm, so this is not a knock or a pat on the back for us, but I know what happens in our firm. We see roughly 1,500 deals a year, if not more. And I can't tell you how many times I open an email that says, I mean, it is several times a week, you are the absolute perfect investor for us. You are the only investor we want to have. How do we get you in our business? We might be a good investor for a lot. They're not going to be a perfect fit for us. Not everyone. And so we have to own that. And we have to say, here are the things that would make you a perfect fit for us. We can help you, by the way, from here to here by giving you our services team. So you can take our ops team or our strategy team, because we still do work for hire. We can help you build that infrastructure to get there. But here are the parameters that we need to start looking at a company as an investment. And we put it out there. On the flip side, it's true. The eagerness to either have that specific investor or just get any capital in the door drives people to give information that may not be accurate. And I think my plea is, an unsophisticated investor will not identify that right away. They'll sit in the boat with you. And that's, by the way, many investors, so you can pull the wool over the eyes of a lot of them, frankly. But it doesn't help you, because as you advance your business and your business doesn't perform there, it gets contentious. A very sophisticated operating investor will call your shit tomorrow. And now what do? And so it's better to say, I actually don't have a business that's going to fit into that. What do I do?
Yeah.
And part of it is about mentorship and the ability to develop a company. Not every business in this space needs to raise capital, by the way. Some very, very successful companies who have exited have grown from $0 to $50 million or $0 to $30 million on no capital at all, and then took in growth capital. You have to just build the business right. The timing has to be right and the market has to be right. And the other thing I have to say to that is, just because you eat your product religiously does not mean that you are solving a problem for enough people to want to buy it in mass scale.
And I don't think that, I mean, I work specifically in what I call the good food space, right? I believe in regional food systems. I believe in local food systems. And I don't think that every food business that exists, CPG or otherwise, needs to be a national brand. I just want to share that philosophy that I have with you, because I think, something that we talk a lot about is like, you don't have to be a national brand.
That's 100% accurate, but then it's just a different life cycle, right? And that's perfectly acceptable. Not everyone needs to sell to a conglomerate. Not everyone even needs to sell, by the way. Like, we're talking about my dad's business as an example. This is a multi-decade business that's not going anywhere till the dude decides to as far as I know, we don't even have a succession plan. So it has no desire to sell. There are many businesses that are passed generation to generation in food. And by the way, some very, very large multi-billion dollar businesses also.
Yep.
People, I think, are often after the glitz and glamour of raising capital, of growing quickly, of like that whole thing. It comes with a lot of fucking problems, people. Like, that does not have to just be the path. And I'm here to tell you, and my partners would probably laugh at me. And by the way, I'm very fortunate. I have a co-founder and his father, who I also consider a co-founder. The father, who I've inherited as my dad, whether he inherited me back, I still don't know. He's the former CEO of Credit Suisse. So we're talking about a real freaking dude out there who gets building companies and investing, right? And fortunately believed in me and believed in what I wanted to do in this space. My first business really became a beautiful lifestyle business. It scaled. It threw off cash. It was a healthy business by business fundamentals standards.
Yeah.
Many people would have been very, very happy with that business. I just wanted something much bigger and to make a much bigger impact.
Yeah.
But I never had investors. I did it without anyone and started a business with $11 in my bank account, literally. I never had to report to anyone, never had to tell anyone anything, could make any decision I wanted to make. And it was amazing. I now have exactly the opposite of that. I run a business that's full of compliance, full of numbers, full of auditing, full of reporting, have investors to report back to people. And thankfully, my investors trust us a lot. They're not in our stuff all the time, which is beautiful and amazing. But still, I go to bed every night with a very different weight.
Yeah.
That I have to return these people's capital who believed in me and in what Siddhi wants to do here. That is completely different than saying, I want to add another 0 to my net worth by myself.
Yeah.
And so, I'm a walking example that it really adds a whole nother layer of dimension.
Yeah. I think everything you're sharing is just so great. I mean, you're very realistic, which is a sort of a simple word, but it has a big meaning in this moment when I'm saying it, right? To be able to say, this is the reality of investing. This is what investors are dealing with. This is why, some of the reasons why we can invest in one business and not another. These are the conversations that we should be having. We, as in what is it? The royal we, everybody, every founder who's having an investment conversation and really driving home that point of honesty and transparency with yourself and whomever you're talking about having any kind of partnership with, really. And I think the more times that we can share that with founders and from the more directions that we can, and you're the first, fund and an investor of this type that we've had on the podcast. And I think it just adds a lot more weight to what we're trying to do here on the podcast and throughout the industry. So I'm really grateful that you're you're here and that you're sharing what you're sharing. So thank you for that.
Yeah, for sure.
Well, I could stay here and talk to you for much longer than the hour that we've been here today, but we'll sign off for now. If folks want to learn more about Siddhi Capital in general or more about you, give us some places where they can go to check you out.
Yep, siddhicapital.co. Don't make the mistake to go to .com. So SIDDHI capital.co. And my email is effectively the same, Melissa, MELISSA, at siddhicapital.co.
Amazing. Well, thank you again for today, and then we'll see you soon in the near future. So much.
This was amazing.
Same.
Want to hear more of Sarah's conversation with
Melissa?
When you support the Good Food CFO podcast through your Baba Yacht membership, you'll get access to our archive of bonus clips, including 2 exclusive conversations from this episode. Just click the link in the show notes or visit thegoodfoodcfo.com and click on podcast bonus clips.
Thank you for joining us here today. If you enjoyed this episode or found it helpful or inspiring in any way, please share it with your founder friends on social and rate and review the podcast wherever you listen. It's the #1 way to help good food founders find the show. We'll be back with a brand new episode next week.